The lenders are preparing for a massive wave of foreclosures in the near future, and today's buyers are indeed speculators. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. It's probably turning your stomach. I know how you feel. Randy Patrick here, putting the realism back in real estate. Today's the 13th of May. Hope everyone's doing well. First of all, if you happen to not catch my Facebook Live deal the other night, guess what? Because it's recorded, it's actually posted on the Facebook page, Housing Bubble 2.0. Go to @HousingBubble2. You can catch the, I guess they'll call it the replay right there. So there you go. You didn't really miss anything. For those of you that did attend live, I do appreciate it, but you can watch it again or watch it for the first time on the Facebook page. All right, we're going to talk about some interesting stuff today. So foreclosure starts jumped in 24 states in April. So the foreclosure stats came out for the month of April. So just so you're aware, we basically had some filings that were jumping up in the state of Washington, New York, Kentucky, Alabama, Indiana. This is the states with at least 100 foreclosure starts. There's been some changing going out there. Now, basically, everyone's going to talk about how virtually all of these foreclosure starts are made up of vacant or abandoned properties, which or the foreclosure activity. So that's what they're talking about here. But foreclosure starts are not necessarily on vacant or abandoned properties. So things are starting to pick up. Please keep that in mind. All right, so let's get into it right now. Okay. Clearly, this is from Adam Data Solutions. So foreclosure activity declines overall as the government moratorium passes the 1-year mark. So please be aware of that. Now, the interesting thing about it, though, is that even though the overall decline is there, we're still seeing a lot of activity start up again. So we're in the 14th month since the pandemic was in. So the moratorium has been in place. Places like Delaware, Nevada, Illinois had the highest foreclosure rates. Foreclosure rates typically are based on, per capita, like one for every number of housing units. And they sort of break it down by state, by metro size, whatever. So you've got states. So, of course, Nevada, Delaware, and Illinois had the highest foreclosure rates from a state perspective for filings. Foreclosure starts in I guess you could say in April. Among the 220 metro areas, the population greater than 200,000. Macon, Georgia was up there, Provo, Utah, Pensacola, Florida, Cleveland, of course, Beaumont, Texas. Those metros with at least 1 million population. You had Cleveland again, Las Vegas, Riverside, California, Jacksonville, Florida, Chicago, Illinois. And now when I go to that bottom paragraph, sounds just like the last housing crisis, right? Cleveland, Riverside, Vegas, Chicago, Jacksonville. Okay, all were big heavy hitters during the last housing crisis, so please be aware of that. Foreclosure starts increase monthly in 24 states nationwide. So this is where it gets interesting, because right now we have a choked market, an artificially manipulated market. Things aren't really happening in the housing market right now. So now we're starting to see some movement. So lenders started the foreclosure process on about 355 properties in April, down 1% from last month and down 26% from a year ago. But basically, we're looking at here, you got, where am I looking at here? Washington was up, New York was up, Kentucky up, Alabama up, Indiana up. If you want to talk about counties, you got Los Angeles County was up, Cook County, Illinois up, Clark County, Nevada up, Riverside County up, Maricopa County, Arizona up. So again, all the locations that were really the hot spots for the big appreciation, big devaluing, the last housing crisis, they're starting to rear their ugly heads again and starting to actually process. As things open up, the courts open up, the process opens up, and that's and we're going to see the same locations are back at it. Foreclosure completion numbers decreased 1%. What that basically means is things that have actually gone to either sale or taken back by an REO. Just because there's not much going on historically, even though the starts are increasing, but the sort of backlog has not hit us as of yet. States with the greatest number of REOs in April, so REOs mean real estate owned, so things that were taken back by the lender, include California, Florida, Illinois, Texas, and New Jersey. So again, those locations always leading the statistical numbers for foreclosures. Major MSAs with greater than 1 million people saw the greatest number of REOs, include Chicago, Philadelphia, Riverside, California, Los Angeles, and Miami. So once again, everything to me is kind of lining up as to what's happened before. We're sort of getting in the same play with the same location. So there's no surprises here. But first of all, if you're not already a subscriber to my channel, if you could smash that subscribe button, help my channel grow, I'd really appreciate that. And I've been saying it for quite some time now, but if you think you're a subscriber, could you please just verify? because I've mentioned having a lot of hard times with my channel lately, and love to make sure that you're on there and getting notifications, etc. So thank you very much for helping me maintain the information on this channel. So what also came out this week is a quarterly, the equity. So Adam Data Solutions puts out the home equity, I guess you could say, home equity report, which basically talks about, how much equity is involved now with properties. Equity is, market value minus loan balance. There's your equity. So why I look at this, though, because not only is it an equity report, it also references the underwater homes, which I've talked about fairly often whenever this report comes out. So it was this week it came out, and this is for the first quarter of 2021. So basically the whole idea is that you've got 17.8 million residential properties are equity rich. So what that basically means is that those properties have 50% or less, they're secured by 50% or less of their estimated market value by loans. So in other words, your loan to value is greater than 50%. So you've got good equity, things are great. Now on the flip side, 22.6 million properties, or 1 in 21 homes in the first quarter of this year, are seriously underwater. Now that actually is a drop from the previous quarter, which was 3.2 million homes. So we do see a drop in that. And I can tell you, the past couple of years we were having it sort of plateau at 5 million. Then it kind of dropped to that low threes. Now we see a little drop below 3 million homes. So we're now at 2.6 million. Now that's to be expected, because if we have these high home prices and all this equity, of course you would imagine that homes that were previously underwater are now passing that threshold. But I want to point out here, all right, that the number they talk about here, this 2.6 million, is seriously underwater. So what does seriously underwater mean? Seriously underwater means that the loans secured by the property are at least 25% more than the property's estimated market value. All right, so that's the whole point. It represents almost 5% of all the properties across the U.S. in a mortgage. So in theory, your home's worth a market value of $100K, and your balance is at least $125,000 on your loan. So therefore, if you were to sell your property, your loan payoff would be $125K and greater, which would mean you would have to bring money to the table if you were selling your property. Now, who's going to do that? I don't think anybody's going to pay a premium to get out of their property at this point in time. There's other ways of handling that. So this is seriously underwater. What they don't talk about, which I always find interesting, is the fact that, what about just the underwater homes? So how many homes are 1% to 24% underwater? We never know that number. So you see, so we talk about equity rich, which is great. We talk about seriously underwater, but there's never a description put out as to just underwater homes, whether it's just, so I want to know what that 1 to 24% number is. Don't know if that's ever going to become available to us, but just interesting to know that this is the numbers, okay? The South and the Midwest continue to have the highest seriously underwater shares. So basically places like Louisiana, West Virginia, Illinois, Arkansas, Mississippi typically are the places that have the most underwater loans. The smallest places underwater loans are Oregon, California, Arizona, Washington, Utah. So of course those are more rich equity places, especially with higher price points and higher or faster appreciation on the West Coast. So there you go. So, places where you got to look where there's a lot of issues are Baton Rouge, Louisiana, Toledo, Ohio, Akron, Ohio, New Orleans, Louisiana, Youngstown, Ohio. So typically, again, those are the cities or townships, locations that have always sort of been plagued by having underwater homes, which really means that, from the last housing crisis, this volume, these locations have not really recovered. So they're ripe for more problems if there's a future housing crash and crisis. Now, at least 25% of mortgage properties were seriously underwater in 51 zip codes. So we can talk about the zip codes. Basically, the highest shares, there's 5 zip codes at the bottom paragraph there. Paradise, California, I looked up on the map, but where's Paradise? That's north of Sacramento. It's kind of, we'll say it's east and northeast of wine country, so east of Sonoma, Napa area, north of it's around Chico, I believe, north of Sacramento there. The other zip codes are 3 in Cleveland and 1 in St. Louis. So these zip codes in Cleveland and St. Louis typically always lead with a significant amount of underwater properties, and that's basically underwater properties, value, and all loan segments, etc. So I thought I'd take a little quicker look at this. So what I did is I went into some other data that I have my access points to, and this is FHA delinquencies. I just thought I'd pull that up. So you can see on the top, left, that zip code has 22.3% of FHA loans are delinquent. The one on the right in Cleveland, 18.7%. The two in the bottom are Cleveland, 20.4 and 20.2. So it just kind of shows that, hey, if you got some zip codes that are, that are leading the nation in what's called, seriously underwater, mortgages, which, mortgages mean it could be, it's a blend. It could be conventional, VA, whatever, Fannie, Freddie. Then we actually go and take a look at, this is the FHA information. It just shows that, yeah, FHA, roughly 20% in these locations of FHA mortgages are delinquent / default. So there's problems there. So not just with respect to the entire zip code, we just started looking, I drilled down to FHA, and yeah, when you have 20% mortgage default rate, that is significant, and that, I guess, would be indicative of whatever market situations going on in these 4 zip codes. I could not pull Paradise, California, because it's not in a big enough metro that it was able to be found on the data that I use here. All right, guys. So want to make a point here, though. So, foreclosures are starting to kick around. They're starting to come back up here. And, going against the housing narrative, which basically is everything's good, everything's increasing, life is wonderful. So when we take a look about, why we're not going to have a housing crash or crisis, according to today's mainstream or lamestream narrative out there with the media, the previous housing crash, we had poor lending standards. All right, that's one of the big things. Bad loans, bad everything with loans, blah, blah, blah. We had a lack of owner-occupant buyers. That's a big point they try to make. Oh, all the people who were buying in like 2004, 5, and 6 were primarily investors. All right. Well, I know a lot of people who bought their homes, back in 2004, 5, and 6, ended up losing them to foreclosure. They were owner-occupants, okay, but the sort of narrative is a lack of owner-occupant buyers, primarily investors. And then the third point they try to make is what's called rampant speculation. So basically everybody who was buying were speculators, and you really had no intention of either occupying the property or really, maybe you were trying to flip it, do whatever you needed to do to make money. So it really was a money-making scheme as opposed to utilization of the product. So it was basically speculation. So these are the reasons why we had a housing crash back in the over a decade ago. So please keep that in mind, because what we're going to talk about now is why we're not going to have a housing crash or crisis. Well, this is the reasons why, and it's very, very evident if you start looking at these articles. And all the pro-housing people talk about this constantly. They talk about it constantly. It's almost like they're like that narrative. It's like ram it down our throats because you need to believe what we're saying because everything's going to be okay. Well, we have better lending standards now, so we're not going to have a housing crash or crisis because we have better lending standards. Number one. Number two, owner-occupant buyers. The number of buyers out today are owner-occupants. All right, they're the ones that they want to live in these properties. So that's why we're not going to have shenanigans going on, and we're not going to have a housing crash. And also, no speculation, because again, the people that are buying for a purpose to live, etc. So there's no speculation involved in this marketplace. So this is the reasoning that if you start looking at all these articles, and they're it's repeating the same thing. Better lending, tighter credit guidelines, better lending standards, whatever you want to call them, for first-time home buyers, primary home buyers. No one's rolling the dice on any risk factor here. Well, okay, let's see if that really is true. Well, guess what? If we start looking at that a little deeper, well, wait a second. This just came out. I found this today. It says volume-hungry mortgage lenders loosen credit standards. I'm like, okay, so basically for the most recent month in April, they saw what's called a mortgage credit availability actually increase, which means they were reducing their standards. Now we know FHA has lower standards. It has lower standard FHA loans, the government-backed loans have lower standards on credit score, on debt-to-income ratio. You can have a lot more debt-to-income ratio than a qualified loan, and the cost to get in the game is cheaper because a 3.5% down payment, and if you're lucky, maybe you'll get some concessions on seller concessions for closing costs or things like that. Those are all available under the FHA loan guidelines. So really, those standards have been down for quite some time, and we've seen, because I've talked about it in other videos, and actually those couple slides ago, those FHA little heat maps, we know that a lot of locations have over 20% in zip codes, if not more, FHA delinquencies or defaults going on. Now, the point to this article is that biggest driver came in conventional space. So, yeah, FHA already kind of takes that other area of borrower, but now we're seeing some changes in the conventional space as well. Listen, as a real estate professional, I get tons of, we'll call advertising emails from mortgage professionals, whatever, and I'm seeing constantly on, loosening standards, state of loan programs, no doc programs, the whole bit. So we're seeing a lot of that right now, not, of course, being picked up by mainstream media here. So, I have to debate that. So we are seeing lower crediting standards, okay? So check that off. Owner-occupant buyers. So, is everybody today an owner-occupant buyer? I don't think so. Why? Because there are actually many investors out there. There's many small investors trying to vie for property. In fact, we're all kind of competing with, so investors are competing with retail buyers for the same property. So that's going on right now. And I can tell you that when we go look at properties, if it's on the MLS, we've got groups coming in wanting to place lower offers and control and maybe resell or flip, get it under contract. And we actually have owner-occupant buyers that are there too. So there's just as many, there's obviously not as many investors out there as owner-occupant buyers, but there's still a ton. And I can tell you that with all the years worth of TV shows and products you can buy and education online and go into all these events and things like that, there's a lot of people interested in real estate investment. So it's not a new thing here. We're all competing for the same property. There's also a plethora, a ton of many investor lending products. So yeah, you can't go necessarily to a conventional lender and say, I want to have a lending portfolio, please, of good price loans. Well, that's not going to work. But there's a whole other segment that, of course, not everybody knows about, because unless you play in that market, you're not going to. It's a whole other segment of providers that just lend. So there's mortgage companies and lenders that just lend to investors. They lend on fix and flip, and they lend on cash flow rentals, all right? And a lot of these lenders are not necessarily concerned, well, there's some concern, but they're not focusing on credit score and things like that. They're more concerned on the property value, its rentability, what it's going to pull the whole bit. That's how they gauge their interest. So yeah, there's a lot of stuff going on in the investment world behind the scenes, and realize that a lot of the investing that goes on may not be on market MLS purchases. A lot of it is off market, and therefore that's why it's not being picked up by mainstream media. So just please keep that in mind. So there are a lot of investors still doing stuff, small ones all the way to big ones. They're out there in the field. So not everybody's an owner occupant. Now, no speculation. This to me is the most important thing that I'm going to say in this video. So I was thinking about this the other day going, well, what do we see right now? Well, they're saying there's no speculation. Well, wait a second. What do we hear almost on a daily basis? You can type this in on the internet right now on any website and talk about bidding wars for homes, and you're going to get tons of examples. You're going to see pictures of people lined 100 to 200 people deep going to an open house, and you're going to hear about all these bidding wars going on. So as far as I'm concerned, if you participate in a bidding war, so if you're one of those people that are going to need a house badly, and you're going to jump into a home, and you're going to go there with, walk the house and view it with 100 other people, and then you're going to get into a bidding war, and you're paying $100K over list price, and you're okay with that, aren't you speculating? Like, put this in perspective here. Speculation basically means, I think I talked about this in a past video, like you're rolling the dice thinking what you're doing today will be okay because it's gonna work for you in the future. So that's what's happening right now. So if you're a primary owner-occupant home buyer and you're going to spend, $100K over list price, I'm just taking that number out, as, who knows the list price. I'm just saying, so you're paying $100K over list price because you have to have that property. What's the justification for that? Is it that I got to have a property? I don't care that I'm overpaying for it. Are you that desperate for a property, or the need's that great? That could be your own personal thing. That could be it. Or are you influenced by today's real estate price points that they keep going up, and in fact are a bubble, because you think, well, if I pay $100,000 over it today, by this time next year, or 18 months or 2 years, the rate, the pace the market is going right now, I'm going to make that up. So if anything, I'm going to break even and I'm covered. Well, that is speculation. So when I look at this and I go, anybody, these bidding wars that are encouraged Okay, buy real estate, and encouraged by lenders with low interest rates. They're encouraged by real estate agents who essentially are setting this stuff up, right? They know exactly what they're doing. I mean, I've seen it out there constantly. It's a good strategy, right? You list, you list the property at a reasonable price point, and then to bring the people in to get them excited. And then you basically say, after this weekend, we'll be taking highest and best. So, what that really means is no offers below list price, and we're going to push the volume on this. So I look at it going, if we're participating, if we're allowing, if we're encouraging bidding wars, and we're okay with people buying, paying way over list price, then we're in a speculation world. And that is bubble territory right there, guys. So those who think that we're not going to have a housing crash or crisis because there's no speculation, they need to reimagine, because I guess that's kind of a new term we're talking about now. Need to reimagine what's actually going out in the real world, because this is what's actually happening. And as I said, just go on the internet and type in homes being sold for over list price or some phrase like that. You're going to see all these articles from different parts of the country, from Philadelphia, from Vegas, from San Francisco, from anywhere in the country, about what's going on right there. So to me, this is actually happening. This debunks the fact that we don't have speculation. So when I actually look at, what's going on here, and I forgot to put my check mark in there. Well, I apologize for that. So anyway, why there's no housing crash crisis? Well, I think that really. I'm going the wrong way. That's the reason why. Okay, guys, I'm sorry here. Okay, so there's my third check mark. Okay, so better lending standards. Well, you know what? That's changing. Owner-occupant buyers, yeah, but not everybody is, and no speculation. Well, speculation is happening. It's rampant speculation now because, as I said, if you're going to push the envelope with the bidding war, and you're okay doing that, and here's the thing, too. It's the complicity. So in the last housing crisis, I can tell you that everybody was complicit. You see what I mean by that is I was in, my real estate office, and, there'd be somebody who was doing a mortgage, right? So the loan officer would say, well, we're going to, the price point is 600 grand, and you need to be 90% LTV. And what we need to do is we got to do it so that no money comes out of your pocket. So they call up their mortgage rep from Countrywide and say, hey, when you get your appraiser out there, it's got to be appraised for over 90%. The sale price is 600, so therefore it's got to be whatever. So when the loan to value works out, we're good. So of course the rep would call the appraiser and say, like the Countrywide rep would call the appraiser in between spraying champagne all over the place, and having nights out and eating at fancy sushi restaurants. They call the appraiser and they go, oh, by the way, on this home it's got appraised for X. Can you bring it in? And lo and behold, they bring it in, 5 or 10K, really close to that. So it works. So you see, all that's complicit. And I look at it going, it's complicit now because we have low interest rates, because, real estate agents are, the government's allowing this to happen. We have real estate agents who are creating these bidding wars. We have obviously, if people are winning these bidding wars and they are actually buying the property with a mortgage, then obviously the appraisal is working. Not that I'm hitting on the appraiser market here, because right now, if you go do a mortgage, you can't pick your own appraiser. It's farmed out, so you have no control on the influence. But ultimately, in the end, they're coming in and they're closing. So I look at it going, it's all happening once again, exactly what happened in the last housing crisis. So that's why I expect that we're going to start seeing some stuff happen. But what about this? So even if you don't believe what I just said, and don't care and think I'm full of it, which is your prerogative, what about this? Okay, 3 things that I'm going to talk about very quickly here. So I know it's a longer video, but I think it's very important. CFPB, Consumer Finance Protection Board, has gone on record warning lenders, banks, and servicers, I talked about this before, that get your act together, get ready to help your homeowners because of the volume that you're going to get. We don't want to repeat the last housing crisis where people lost their homes because of no response or no help. So that was a poor situation. So at least this time around, there's an effort. Let's have an effort to help people keep their homes with products, services, or workarounds from these companies. All right. So that's out there. The Florida Supreme Court directive. What's that directive, in case you don't know? Well, the Supreme Court of Florida basically said to all the local counties and civil courts, they said the same thing, going, get your act together. We're putting in some aggressive case mediation, we'll call it benchmarks or conditions, because what they don't want to have happen is it's taking 3 years to things to process in the court, the whole bit. Why are they doing this? Because they know the volume is coming, all right? So that's my point here, is that as much as we can say we're not going to have a housing crisis or crash, no foreclosures are going to happen because of all this equity. Well, there are groups here that certainly are not on that wavelength, and they're preparing for the worst. So I'm going to go with the group that's saying we've seen this before. Obviously, they're privy to information that you and I don't always have out there, even though I'm trying to data mine for it the whole bit. So basically, the Supreme Court directive in Florida is get your same thing, get your acts together, get everything done, and they're going to burn through these foreclosure cases. So it's not going to take 4 or 5 years. It's going to take much quicker. I've already seen stuff go for 6 months down here in Florida just before COVID. So that was a big speed up here. So people are going to be shocked at how fast this is going to happen. That's why I'm saying this fall hits, be aware of what's going down. Now, finally, behind the scenes lender activity. Now, what is that? Well, one of the things that I'm doing is I talk to a lot of people, I have a lot of contacts, attorneys, economists, asset managers, whatever. So I'm trying to find out what's happening. I can tell you this, and it's been substantiated by more than one source of people I deal with, is that the lenders now are starting to do what's called broker price opinions and valuations. So they know that all this forbearance stuff is coming to fruition in a couple of months, and that there's going to be some problems there. So they've already started the process of ordering valuations. So just so you guys are aware, typically what happens is that when someone doesn't pay their mortgage and they go delinquent, whether it's a licensed real estate agent or maybe an asset management securitization company, they're going to drive by the property in question, and they're going to see whether the property is vacant or whether it's occupied. Now, if it's vacant, then the securitization company is going to jump in there. They're going to change the locks. They're going to secure it to make sure that there's no damage, there's no vandalism, there's no insurance risk, the whole bit. They're going to secure it, which basically is locking, fixing broken windows, stuff like that. So that they maintain it. They cut the grass, and they may come out once or 2 months to check out and inspect the property. So that goes on. Also, with a broker or a real estate agent, they do what's called a BPO, or a broker price opinion, which basically means that they do a drive-by. So they can't get in the house. They obviously do a drive-by, take some exterior pictures of the structure, of the road. They do evaluations. So they're supplying the lender, bank, servicing company with a valuation to say, hey, I drove by. It's either vacant or occupied, and here's a sort of generic, if the home's in an average condition, here's the valuation for today's marketplace. So that's what happens, and that will happen more than once down the road. So the fact of the matter is that lenders are already kind of what's the word I'm looking for, like they're not the word monetized, but they're mobilizing. Sorry, they're mobilizing that part of the workforce and starting to order these BPOs now. Tell us that they know that they have to start doing this now, because some of the stuff's going to start to fall down in the near future, and they have to be prepared. So that's part of the preparation behind the scenes. So that's really what this lender activity is here. So for those of, so that's not even talked about in mainstream media. Why? Because no one picks up on that. So the other talking heads that are out there that you're watching their videos, they're not even talking about stuff like this. I can guarantee you that right now. That's the whole difference, because I'm out in the street, I got the intel, I'm working the angles to find out what's going to happen, and I have to capture that information to decide how we're going to pursue the market, etc. So when you play in the distressed market, that's what you look for, and that's sort of the stuff that you find out. So this is going on right now. So ultimately, CFPB, Florida Supreme Court, you may see other courts following this directive down the road, and the whole BPO valuation securitization things are starting to pick up the pace, which means that expectations that we're going to have stuff happen. That's my title of massive foreclosure wave coming. Well, you know what? If they didn't think there'd be problems, why would they be doing this and preparing right now? Among the other things I've spoken about previously. So there you go, guys. So what's next opportunity here? Well, you know what? Owners will need to sell. Investors need to liquidate if they're caught. You'll see an uptick in foreclosure auctions because things are picking up. Foreclosure starts are picking up because we're going to. Well, first of all, uptick in foreclosure auctions as they get back on track. Uptick in foreclosure filings because they're already upticking right now. We'll eventually see more short sales listed, eventually increase it in REOs after they go through the auction. They'll be more available than predicted. We're not seeing the true numbers. My feelings on that. So just as an FYI, why do you want to get involved in this business? Because of equity. This is an example of my MSA where I live. The difference between a traditional median sales price and a regular short sale median sale price is about 77K as of February, when the last MSA report came out. I update this every time there's a new one that comes out. All right, pluses and minuses, but the whole point is distressed properties do give you discounts even on a retail level like this. They'll get you more if you go off market, etc. And guys like me, we know how to work the short sale, short sale process to get greater, deeper discounts than what we're seeing here. So please keep that in mind. So having said that, if you want more information, gethousingdata.com. Check that out. It's sponsored by my partnership with foreclosure.com, which basically is go look at, they have the #1 website for the largest number of distressed property listings across the country. So gethousingdata.com. Go check it out. And if you want more information about how you can work with me and the stuff that I'm offering, definitely send me an email. I'll tell you about it. Guys, as I said before, it's time. Things are happening. I guess you could say the housing bubble not popping, not having a housing crisis, I guess you could say narrative is starting to get blown out of the water because of the things that are happening behind the scenes. Not apparent in mainstream right now, but apparent to people like me and you who are watching this video, etc., and are in the know. And that's where we're going to succeed at either getting cheaper properties or doing better investments as time goes on. All right, guys. So thanks for the likes. Thanks for the comments, views. Please share this video with your family and friends. If you're not already a subscriber, please subscribe. Look forward to speaking with you in a little while. Take care.